All right, everybody. So the Fed decided to hold steady on interest rates for now. And ultimately, the market did rally a little bit, but there has continued to be volatility in the markets, both for stocks and bonds since then, and largely related to tariffs and inflation. We don't need to get into that. But what I wanted to do is look at this concept of being bullish on bonds, okay, which may sound a little crazy because over the last 15-ish years, stocks have significantly outpaced bonds. Okay, we've been in a historically low interest rate cycle, but now interest rates seem to have peaked. And now if we're on the downward trend, what is the impact on bonds and ultimately their prices? And so what I did in preparation for this, I looked at 5 historical periods since the 1980s when interest rates were on the downward trend. So after they peaked, ultimately they were on the downward trend. And I wanted to look at the impact on performance, both on stocks and on bonds. Okay. And I think you're going to be really, really interested to hear the results. If you're new, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner of Imagine Financial Security. We help individuals over 50 with over $1 million maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to follow the podcast and make sure to subscribe to our YouTube channel. We put out weekly retirement-related content specifically designed for you all, PFR Nation. And of course, if you're interested in learning more about working with our firm one-on-one, you can visit our website at www.imaginefinancialsecurity.com, or you could start with the Retirement Readiness Questionnaire, which is linked in the show notes. Okay, so you all know this already. I've already talked about this on the podcast, and you probably heard in the news. We hit correction territory, which is a 10% drop on the major stock indices on the S&P 500 and also on the NASDAQ. But also more recently, the Consumer Sentiment Index, the University of Michigan benchmark, hit 57.9, which is the lowest it's hit since 2022 when it hit 50. So naturally, we're fielding a lot of these questions, about the markets and around concerns around tariffs, government policy, interest rates, inflation, etc. But if we if we try our best to put tariffs aside, because there's a lot of noise about tariffs and I get that, but let's listen to what Jay Powell said about interest rates going forward and ultimately what he believes the impact on tariffs to inflation will be. His words, his quote directly was he believes they will be transitory, okay, which is a little concerning because that's basically what he said in 2022 about inflation. He thought inflation would be transitory. Turned out not to be the case, far from it, very sticky inflation. But let's say, let's say tariffs and the impact on inflation in 2025, maybe it's a slight step backwards, but ultimately the plan is to continue the rate cut journey into later part of 2025, even into 2026 and 2027, okay? And so what I want to do is I want to look at, okay, what happened in the past during these rate cut cycles? What was the discrepancy between stock and bond prices and who outperformed who? And we're going to keep some tabs here. We're going to keep track on this one. And we're going to start with the 1980s. Okay, we're going to call this the Great Inflation War. Okay, so the period from the 1970s into the 1980s, inflation ran super hot. It peaked all the way up to 14%. And as a result of that, the Fed chair, Paul Volcker, aggressively raise interest rates all the way up to 20%. I mean, imagine that. I mean, right now the Fed funds rate, is in the mid 4s, okay? The Fed funds rate peaked at 20% in 1981 to try to combat inflation. Okay, very similar story, but we just did not have as severe an inflation as we had back then, okay? And there were a lot of things going on in the economy back then. We're not going to get into that right now, but ultimately the Fed began that rate cut process mid-1982. Okay, so if we look at the performance, I just want to look at the performance of bonds and stocks from the period from 1981 to 1988. Okay, because 1988 was essentially when rates sort of bottomed out. Okay, so like kind of the rate cut process began late 1981 and then kind of ended in 1988 when rates sort of bottomed out. But if you look at the S&P 500, it did fine. It did very, very well, as a matter of fact. The S&P 500 responded very well, and it returned about 9.8% annually, okay, from that in that 7-year period. And it makes sense. I mean, when rates go down, it stimulates the economy. Money becomes a little bit easier to access, and because interest rates are lower, mortgages are less expensive, cars are less expensive. It's easier for businesses to borrow money. So it definitely makes sense. As interest rates fall, it stimulates the economy, and that's oftentimes why rate cuts are enacted in the first place, to try to stimulate the economy, sort of pull ourselves out of a recession, okay? But bonds, look at the bond returns, okay? From that same period of time, from 1981 to 1988, bonds return an average of 13.8%. Okay, so essentially they outperform stocks by about 4% a year or 400 basis points, which is significant. So keep that in mind. That's a winner for bonds in this first period of time. Winner for bonds. Let's go to number 2. Early 1990s, We had a little mini recession. Okay. We'll call it the Gulf War was a big factor in this, and oil price shocks. Oil prices ran up significantly. Okay. So when oil goes up, oftentimes businesses and consumers alike, their costs go up significantly. So that kind of slows the economy down a little bit, and ultimately recessions sometimes result from that. But ultimately from 1990 to 1991, we're going to look at this period of time when really the rate cuts sort of began a little bit earlier than that in 1989. Okay, so rates were sitting at about 9.75%. Again, historical context, right now we're in the mid fours. So the Feds were at about 9.75%. And this was partly because we had a significant run up in the mid 1980s on the stock market, and sort of like inflation started to heat up again. And I think, in my opinion on this one, I wasn't in the room, but I think the Fed probably had some PTSD from hyperinflation from the 70s and 80s. So they actually began to raise interest rates in the late 1980s. And again, they peaked at about 9.75%. But the economy fell into a recession, around the mid 1990s. Okay. So the Fed began cutting rates at that point in time. They cut rates through 1992, but rates continued to kind of fall. So what that means is when the Feds cut rates, like what I'm talking about is their benchmark policy rate. Okay. So there's the Fed funds rate and there's the actual interest rate. So oftentimes they'll cut rates, and sometimes the market reacts right away to that. Sometimes it's a little bit of a delay. In this case, it was a delay. And so rates sort of bottomed out around 1994, where they bottomed out around 3%. Okay. So again, rates 9.75 bottomed out to about 3%. And the S&P 500 during that period of time, if you look at the S&P 500 from 1989 to 1994, it returned pretty solid again, 9.5% annually. But look at this one. Bonds returned 9% annually. Okay, so I'm going to call that one basically a tie, but we're going to give a narrow edge to the S&P 500. So we're 1-to-1. S&P 500 won narrowly, and then bonds won significantly, 400 basis points in that first period of time. Let's look at number 3. So the third period we're going to look at is the dot-com bubble bursting. Okay, so many of you remember sort of the rise of the internet and all of these dot-com companies. Anything with a dot-com at the end of their name, like those stocks just significantly shot up just because of speculation in the late 1990s. And that bubble burst around 2000, 2001. Okay, and the Fed's interest rates were sitting at about 6.5%. Okay, around, that was probably early 2001. And they began to cut rates in 2001 because ultimately there was signs of a recession. So they began to cut rates to try to stimulate the economy, try to create a soft landing. And they cut rates all the way down to about 1.75% by the end of 2001. And then there was a lag effect. So interest rates continued to fall all the way down to about 1% by 2004. So we had this period from 2001 to 2004 where rates peaked and then fell. So if we look at this period of time, the S&P 500 returned a negative 0.26%. Bonds during that period of time returned 6.775%. So again, winner for bonds, loser for stocks. And that is a significant outperformance by over 600 basis points. Okay. Again, we're looking at past performance here. There's no guarantee of what's going on in the future, but that's 2 out of 3 so far where bonds have outperformed stocks during that period of rates going down and ultimately hitting a recession or entering a recession or coming out of a recession. And then, yes, stocks did rally, but ultimately during that period of time from 2000 all the way up to 2009, we had 2 recessions there. We had the dot-com bubble bursting, and then we had the Great Recession. So this was really that period of time from the lost decade where stocks were essentially a negative rate of return for the first time ever in that decade. Maybe it's a little unfair to call this one out, but again, that's legit. I mean, bonds did perform well during that period of the downturn, even when there was so much volatility in the stock market during that period of time. And that makes sense. When people sell out of stocks, they flight to safety, they go to bonds. All right, so now it's 2-to-1 in favor of bonds. Let's go to 2007, beginning really the front end of the great financial crisis, the Great Recession of 2008. This one was the collapse of the banking system. Ultimately, these subprime mortgages, were really oversold, and they were really backed by just bad mortgages, poorly underwritten mortgages. People that probably shouldn't have been qualifying for homes. Everyone was qualifying for homes back in the mid 2000s. Ultimately, what happened was, the Feds began to cut interest rates in September of 2007. There were kind of some signs of a recession happening already at that point in time. And interest rates were sitting at about 5.25% in September. Okay. And they cut interest rates basically down to 0. Okay. By December of 2008, interest rates were 0. We went into the worst recession we've all seen in our lifetime. Okay. And the Fed rate cuts combined with other things, other emergency measures like bailouts and stimulus, quantitative easing, eventually contributed to a recovery, but ultimately it was a very slow climb out. I mean, that it took about 4.5 years for things to recover on the stock side. But ultimately, if you look at that period of time from 2008 to 2012, stocks returned 2.23% annually and bonds returned 5.92% annually. Again, we've got a winner for bonds by roughly 370 basis points. Okay, so we've got 3 out of the 4 periods that we just looked at, bonds significantly outperformed stocks. And then one period, it was basically a tie, a narrow margin for stocks. But we'll give stocks a bogey on that. We'll let stocks, they took the reins there in that period of time. All right, the fifth one we're going to look at is the COVID-19, the global shutdown from the pandemic, okay? And things really began to shift from a policy standpoint from the Fed around July of 2019. They actually began to cut interest rates a little bit. So actually, interest rates began to rise in 2018 because, we were basically at 0% interest rates for basically a decade, since 2008, since the Great Recession, all the way up to 2018, it was basically free money, 0% interest rates. And so the Fed began to raise rates a little bit to kind of prevent from the economy from overheating. Okay. We had a lot of stimulus from the Tax Cuts and Jobs Act, but then there was some concerns around inflation starting to tick up a little bit. And ultimately global trade was also a concern as well. The Fed began what we call like insurance cuts, really in July of 2019, due to some of the slowing global growth and some of the trade tensions. We were not in a recession yet, but then the pandemic hit. And then they cut interest rates aggressively all the way to zero again. And the interest rates continue to fall, really through the early 2022. But then in 2022, they raised rates aggressively. So 2022 was tough because it's sort of like it bottomed out and then interest rates all of a sudden shot up because, again, the Fed policies in response to the highest inflation reading we've seen in 40 years. But if we look at that period of time from 2019 to 2022, stocks returned very solid, 13.14%. Okay. Bonds, on the other hand, returned 0.42%. Okay. So again, stocks significantly outperformed bonds in this period of time, but that also includes a period in 2022 where bonds returned minus 13%. I looked in the past record, I could not find another year where bonds were negative double digits. Okay. There was a couple of years where bonds were negative returns, and that was, really in response to interest rates on the rise. Again, the inverse relationship to interest rates and bond prices. I think there was maybe 1, 2, 3, 4 periods of time prior to that where bonds were even negative from a return perspective. Because even if there are some changes in interest rates, oftentimes the interest payments from bonds kind of keep things a little bit stable from a performance perspective. But interest rates were basically next to zero and bond prices fell down because of interest rates going up in 2022. But even with that, like I said, we're going to give the S&P 500 stocks a significant winner on this one. But if we look at those periods of time, those 5 cycles when rates were on the downturn, okay, there was never a period of time where stocks were a negative rate of return. Okay, so is this me coming in here and say like, hey, let's bail on stocks and go all into bonds? Absolutely not. Okay. But if we look at those 3 out of those 5 periods, bonds did outperform stocks. And actually one of those 5, it was a very narrow loss on the bond side. It was basically a tie. Okay. And so again, stocks were always positive. Every single period of time we looked at, stocks were positive, except for that small blip in the radar in the early 2000s. It was flat just by a narrow margin. Okay. It was a negative 2.2%. But that excludes dividends. So if you include dividends, it was basically flat. Okay. So there was one period of time where stocks were negative, one period of time where bonds were basically flat. Other than that, pretty positive returns for both stocks and bonds. But again, 3 out of those 5, bonds significantly outperform stocks. Okay. So here we are. We're sitting here and the Feds began to cut interest rates in September of 2024. Okay. There were 3 rate cuts in 2024 for a total of about 1%. And I'm a big believer in the law of averages. And again, I'm not saying sell all your stocks and buy all bonds, but as you approach retirement and you're like, hey, as you approach this idea of, okay, now I'm going to need to draw income from the portfolio. I need potentially some stability to take money out in periods of downturns. It is a healthy period of time right now to really think about your investment allocation and what percent you want exposed to the stock market and what percent you want exposed to the bond market. Okay, because oftentimes after run-ups in the stock market, okay, it's very important to not get too overly optimistic. And we had 2 back-to-back years of 20% gains in the S&P 500, both in 2023 and 2024. So it's important not to get too overly optimistic, but instead like rebalance to those target allocations that you selected given your risk tolerance, given your risk capacity, given your time horizon. Okay. Additionally, I mean, many times we've had these conversations with clients. Many people will look at the historical context of returns in sort of a recent cycle. And they'll sort of look over the past 1, 2, or 3, maybe 5 years. Okay. And if you look at the performance on bonds, it has not been pretty since basically the 0% interest rate environment that we had since 2008. Has not been pretty. Okay. Stocks have been the clear winner for that entire duration. Okay. But now that interest rates are on the downturn, I could absolutely see a case where, similar to the 1980s, where bonds actually outperform stocks for a period of two. Maybe not over the long term, certainly not over the long term, then we're in trouble. But ultimately for a period of time. Maybe it's in 2025, maybe it's in 2026. But I think the number one takeaway I would recommend is really thinking through what your investment allocation should be and needs to be to achieve your retirement income goals, and reevaluate this on an ongoing basis. Because just because maybe you're more aggressive today, maybe you're still working, you've got a few more years until retirement. Maybe you're not, hey, I want to load up on bonds today, but maybe you're on the brink of retirement. And you're like, hey, I don't want to retire into a bear market or a downturn. That is the worst time to retire, is a recession or a bear market. But the problem is you can't time that. There's no indicator that is 100% right from a recession standpoint. I mean, otherwise we wouldn't have markets. Ultimately there's got to be some uncertainty. Otherwise there could be no return. There's no opportunity for return. And so reevaluate this the closer you get to retirement, and certainly in retirement. Does it make sense to take some of the risk off the table? But just because other people are getting more defensive, this is sort of the other point of view there. Just because other people are getting more defensive doesn't mean you should. Okay, everyone should have their own unique financial investment strategy, your own unique goals and investment objectives. So I think the biggest takeaway from all of this is, if you're in a situation where, you're a little concerned about the stock market, you're a little concerned about the outlook of the market in 2025 or 2026, bonds are probably going to be a decent place to be for the next 1 to 2 years. So don't abandon your bonds just because you've seen bond performance lag significantly over the last 10, 11 years. Because again, I do believe in the law of averages. I do believe things will catch up. And now that coupon rates, if you look at the 10-year treasury rate, it's hovering around 4.2, 4.3%. That's a pretty attractive interest rate, in my opinion, where you can sort of lock in some of those some of those coupon rates today. And as interest rates fall, now you have not only the benefit of a higher coupon rate, but now you also have the benefit of prices of those bonds going up in response to the interest rates falling. Okay. If you're approaching retirement, you're like, hey, I'd love some help on this one. I want to talk to someone who understands retirement planning and investment strategy. But we would love to hear from you. We'd love to help you in your retirement planning journey and see what an appropriate investment strategy would be for you. Because again, what fits for one of your friends or coworkers doesn't mean that should fit for your situation, your financial plan. You should have your own investment targets, your own investment strategy that is unique to you. So I think in summary here, if you are, let's say you're a few years out from retirement, you're not on the brink of retirement today, maybe you're 5 or 10 years away from retirement. Does it make sense for you to have some fixed income in your portfolio? Maybe, maybe not. I mean, I think the fixed income could be there as a diversifier if you don't have the risk tolerance to be 100% in the stock market. But worst case scenario, maybe it's some dry powder, okay, that you're sort of loading up on some of the safer investments. Again, taking some of the risk off the table from the gains we had in 2023 and 2024, and almost looking at bonds as a source of dry powder, just in case of stocks do go through a further downturn. Maybe we go from correction territory all the way down to a bear market. That's an opportunity for you to take those bonds. Now the bond prices have gone up because interest rates have come down. Now you can take some of those gains out of the bond side and add it to the equity side. So it could be a good source of rebalancing. If you're on the brink of retirement, absolutely, it's a great opportunity to, again, reevaluate your risk tolerance, reevaluate your investment strategy, because now it needs to align with your retirement income plan. And this is one of those things that I love having a conversation with for our clients that are taking income out of the portfolio, is determining how many years of income do they need or want in fixed income, if that makes sense. So if someone has $1 million portfolio and they're 60-40, that means 40% of their portfolio would be in fixed income, or $400,000. And maybe they're taking out, I don't know, maybe it's $80,000 a year from their portfolio on an annual basis in the short term until they start Social Security or other income sources start to kick in. Well, that means they have 5 years of their income targets on the fixed income side. That's a pretty good place to be, because if you think back to the worst recession we've had in our lifetime, the Great Recession, it took about 4.5 years for stocks to fully recover. And you want to prevent selling an asset when the market is down. You don't want to sell low, you want to sell high, and you want to buy low. So again, approaching retirement or on the brink of retirement, you could have some different reasons to wanting the fixed income. And then certainly when you are retired, when you're taking income out of your portfolio, you need to have a healthy amount of some other asset class that's not stocks, because in a significant downturn, you need a place to hide in the short term. And that could be a year, it could be 2 years, it could be 4.5 years plus. I mean, who knows? Again, past performance is no indicator of future results. And so if you think back to the Great Recession, yes, that was the worst one we've seen in our lifetime. But if you think back to the Great Depression, that took a decade to recover fully. Okay. So again, I'm not calling a Great Depression right now, but I'm just saying you need to have a process. You need to have a plan. And if you're interested, if you're like, hey, I'd love to talk to you about our investment strategy and ultimately how we're allocated relative to our goals in retirement and where we're overexposed or underexposed, we'd love to hear from you. Again, do the retirement readiness questionnaire, go to our website at www.imaginefinancialsecurity. We'd love to hear from you and see how we can help you in your planning journey. And if you're finding value in our content, we always appreciate a positive review on Spotify and Apple Podcasts. So make sure to leave that 5-star review for finding value in the work that we're doing. That helps us reach more people, impacts people, which is ultimately our goal for this show. Until next week, this is Kevin Lau signing off.